Somewhere in Frankfurt, a group of central bankers is quietly working on something that could change how every single person in the Eurozone pays for their morning coffee. You've probably seen the term floating around in headlines, the digital euro. And your first thought was probably, great, another crypto thing I don't understand? Except it isn't crypto at all, and it isn't really optional background noise either. Some of Europe's biggest retailers and payment companies have been openly pushing Brussels to move on this, arguing that the current system is quietly draining money, privacy, and control away from Europe. So let's actually unpack what's happening, why it matters, and why this debate is a lot bigger than just how you tap your card at checkout. Right now, when you pay digitally, here's what's really happening behind the scenes. You open an account with a commercial bank, hand over your ID, maybe proof of address, sometimes proof of income, and eventually you get a debit card branded with Visa or Mastercard. When you tap that card at a shop, it feels instant, but it isn't. Your bank isn't paying the store directly. The request travels through a private payment network. That network checks your balance, approves the transaction, and the actual settlement between banks often happens a day or two later, with fees collected along the way by everyone the payment passes through. The digital euro would work on a completely different foundation. You download an official wallet app, verified either through the European Central Bank or an authorized provider, go through a quick identity check, and you'd have a digital euro wallet ready to use at no cost. Picture something like a European, publicly backed version of a payment app, except it's not run by a private company chasing profit. You top it up from your bank account, send or receive digital euros, and pay in stores by tapping your phone. But this time, there's no card network sitting in the middle taking a cut, and no private company processing the transaction behind the scenes. It's public digital money backed directly by the central bank, functionally similar to cash, just without the paper. For financial stability reasons, there would also be a cap on how much digital euro any single person could hold in the wallet itself, with anything above that limit automatically routed to your linked bank account. Now, you might reasonably ask, why does any of this matter if paying with a card already feels easy enough? Here's the part that doesn't show up on your receipt. Almost every card tap in Europe routes through two American companies, Visa and Mastercard, and the fees charged through that system have been climbing fast. An independent 2024 analysis from the Brattle Group found that these card fees rose by nearly 34% between 2018 and 2022, a jump well beyond general inflation, without merchants or shoppers seeing any real improvement in return. On top of that, there's a bigger strategic issue. A huge share of Europe's payment infrastructure runs through foreign, privately owned companies. If political tensions ever escalated, or new sanctions or restrictions came into play, that dependency could become a real vulnerability for how an entire continent moves its money. European Central Bank board member Philip Lane has pointed to exactly this, noting that Europe's reliance on external payment providers has become significant enough to limit its control over a critical piece of financial infrastructure. Then there's fragmentation. Plenty of European countries have their own local payment systems, but they don't always talk to each other smoothly across borders, so people end up defaulting to Visa or Mastercard anyway, even when those systems occasionally fail to work properly abroad. Add to that a privacy concern. Every card transaction leaves a data trail, and a lot of that data gets processed by companies operating partly outside the reach of European privacy law. And finally, there's the innovation problem. European fintech companies are largely stuck building on top of infrastructure they don't control, paying fees to use it, and following someone else's rules instead of building genuinely independent alternatives. The digital euro is designed to directly target every one of these pressure points. No card network fees quietly leaving the European economy, less dependency on infrastructure that isn't under European control. A single unified payment rail that works the same way whether you're grabbing a coffee in Lisbon or shopping online from Berlin. Your payment data stays inside Europe, governed by European privacy law instead of being processed somewhere it isn't. And Local companies get a public foundation to build new financial products on top of, without needing to negotiate with a foreign card network first. For everyday users, the pitch is fairly simple. One wallet that works everywhere in the euro area, no extra currency conversion friction while traveling within the zone, no juggling different apps, depending on which country you're in. It's designed to work offline too, so a lost internet connection doesn't leave you unable to pay. Payments would be free for individuals and cheap for businesses, which matters a lot for small shops currently squeezed by card fees. And importantly, this isn't designed to replace cash or existing bank cards. It's positioned as an additional option, one that specifically works even for people without a traditional bank account, through public and offline wallet access points. But none of this is uncontroversial, and it shouldn't be treated as if it is. The biggest concern critics raise is power. Handing a central bank direct visibility, even partial visibility, into how an entire population spends money is not a small thing. The ECB has repeatedly stated that privacy protections are built into the design, particularly for offline payments, which are engineered to work closer to how physical cash behaves, with transaction details visible only to the payer and the person receiving the payment. Even so, skeptics worry about mission creep down the road, pointing to China's digital yuan as a cautionary example, a system that critics argue gives state authorities significant visibility into personal spending patterns. Whether the EU's legal and institutional safeguards are strong enough to prevent a similar drift is a genuinely fair question, and it's one that will likely define a lot of the political debate ahead. Commercial banks have their own separate worry. If people start shifting meaningful amounts of savings into digital euro wallets, especially during a moment of financial stress, that could destabilize traditional banks that rely on deposits to fund lending. Some economists have flagged this as a real risk factor worth taking seriously, separate from the privacy debate entirely. So where does this actually stand right now? And when might it become real? The European Central Bank began formally exploring the idea back in 2021. And by 2023, it had entered a dedicated preparation phase focused on the technical architecture and legal framework. As of the most recent updates, the plan is to run a 12-month pilot beginning in the second half of 2027, assuming the necessary EU legislation gets approved by lawmakers first. If everything stays on track politically and technically, the ECB is aiming to be ready for a potential first full issuance sometime in 2029, a later timeline than some earlier projections suggested, reflecting just how much legal and political groundwork still needs to happen before any of this reaches your phone. This isn't a settled outcome. It's a genuinely open policy fight involving privacy advocates, commercial banks, foreign payment giants, and European lawmakers who all have very different incentives here. Whichever direction it goes, it's likely to quietly reshape how an entire continent handles money for decades to come.